Hi traders, Jean here from BecomingTraderFX.com, and in this video we will cover GBP US dollar, and I will show you how you can trade when the markets are ranging. So in this case we'll start with the daily time frame. So before we start with the video, I want to really tell you the importance of using the hard time frames. And you must use daily time frame, 4-hour time frame if you want to be successful. So don't just open the charts, don't just go to the lower time frames right away, but use the hard time frames in order to understand the hard time frames structure, the direction, and you will see how your of course overall profitability will increase, and of course how your performance will improve by using the hard time frame. So first of all, on the daily time frame, so we can start as you can see, we can start somewhere here, and it's very important that you focus on highs and the lows on the daily and 4-hour chart. So if you're new to trading or already experienced trader, then of course you understand that in trading you have three different market directions. So market is creating either higher highs, higher lows in an uptrend, or the market is creating lower low, lower highs in the downtrend, or market will move in sideways direction. So when the market is not able to create new low or high. So if you have like a range, then of course this video will show you how you can trade these ranging periods of the market. So for start, we'll use the GBP US dollar. So we'll start here. We can start here on the swing low here, and what you want to do is you just want to focus on overall price movements on swing highs and the lows. So here, as you can see, I will mark the highs and the lows. So when you have one candle on the left side, one candle on the right side, then of course we can mark this as a swing point. So in this case, as you can see, we have swing high, one candle on the left side, one on the right side, market retraced, and as you can see, it spiked here, moved higher, we had another swing low here, and then market decided to move and creates a new higher high. So new higher high was formed here, and then we got retracement, and as you can see here, we had a swing low. So overall, what do we see here? In this case, we have higher low, new high, retracement, another swing low, and then we had new high, and then a retracement. So overall, we have of course a bullish structure on the daily, but now we'll go to the 4-hour time frame. So after this swing high was formed and swing low was formed here, we will focus on the 4-hour time frame. So it's very important that you combine those two time frames, the daily and the 4-hour time frame, because you want to understand what is the structure there on those two time frames. And when you combine both time frames, then of course you can really find great trading opportunities and trading ideas. So we'll mark these levels up on the daily time frame. So we have swing high here, we have this swing low here, down there, as you can see. Let me do it like this. As you can see, this blue candle right here. So we have swing low, swing high, and overall we have, as I said before, a bullish structure as the market is creating higher highs, higher lows. But now we'll go to the 4-hour time frame to see what was the direction there at this at that point of time. So we'll focus on this area up here. So let's jump to the 4-hour time frame. So on the 4-hour time frame, what do we see here? If you just zoom out a little bit, you can see this was the daily swing high, this was the daily swing lows here, this was the daily swing high here, and we had another daily swing low here. So as we said before, we had this bullish structure, and it's very important that after you do your analysis on the daily, you go to the 4-hourly to see what is the structure there. Is the 4-hour chart in alignment with the daily? Is it moving in opposite direction, or is it just ranging there? So you focus again on highs and the lows on this time frame on the 4-hour. So after this daily swing low was established at the start of the week, you can see the price action of the first few days in this week up here. So again, as I said before, you need to focus on the highs and the lows. So we'll focus on from this vertical line. This is the start of the trading week, and we'll just focus on the price. We'll mark the highs and the lows. So this is the new week open. As you can see, market created this low, moved higher, retraced, bounced here. As you can see, this was the high of the week. So you can mark just level where you have the most touches. So you have most touches somewhere here where we have 3 candles in the row. So this is the swing high, and as you can see, this was the swing low. So let me draw this. So we have low of the week here, we have high of the week, and the most touches is in this area. So market then retraced, it formed a little bit of support here, retested the lows here, almost retested the lows of the day of the week down there. So we can all agree that this is very important area. As you can see, we have one touch here from Friday, second touch on Monday here, and then you have also another almost retest of the lows on Tuesday. And what we have on the upside, we have, of course, we have Monday's highs here and here. So we can just connect this line. As you can see, on Tuesday, late Tuesday, market retested again the same highs as on Monday. So what do we see here? Do we have like a price creating higher highs, higher lows, or lower low, lower highs? No, we have just this kind of ranging conditions when the market is not able to create a new swing low or new high actually. So in this case, we have just this kind of a ranging environment, and as long as the market is moving within this range, then of course we can look for possible market structure shift at the lows or at the highs, as long as the market is staying within this ranging conditions. So in this case, we used the trend line. So here, as you can see, we have this horizontal line, and as long as the market is bouncing from those same highs or same lows, we can look for structure shift on the lower time frames, on the 1 hourly or 15-minute time frame. So here we have, as you can see, 2 touches, almost third touch, fourth touch. So more touches you have, more important and stronger is this area. So so what is the trading idea actually? So when you have like a range and the market is trading and bouncing from one area to another, when the market is getting closer to this level, you want to see first, you want to see liquidity sweep, which means that, for example, if you have major highs here, you want to see on the next candle, you want to see this kind of a liquidity sweep. This is a really good example. So when you see this liquidity sweep, like spike price going over all those previous highs up here, this is what you want to see first. You want to see liquidity sweep, and then on the second thing, you want to see market structure shift on the lower time frames, on the 1 hourly or 15-minute time frame. So first, you want to see liquidity sweep here, price spiking over all those previous highs, the hard time frames resistance, in this case the 4-hourly resistance. And second, you want to see market structure shift on 1 hourly or 15-minute time frame. So now we'll go on the lower time frames. So as you get the liquidity sweep, you want to see on the second point, you want to see market structure shift on the 1 hourly or 15-minute time frame in order to look for opportunities at the highs of this range or at the lows. Depends on where the price is. If the market is going to the lows, you want to see liquidity sweep and then structure shift on the lower time frame in order to look for longs. To the upside, if the market is going closer to this resistance and you see some previous highs here, you want to see liquidity sweep and then lower time frame structure shift on the lower time frames in order to look for shorts. Now let's go to the lower time frames on the 1 hourly. Here, so on the 1 hourly, we don't have any structure shift. As you can see, we have previous highs will be marked here, as you can see, we got this liquidity sweep, which is higher than all those previous highs here, but we don't have any structure shift. We don't have like market going to the resistance, liquidity sweep, and then we see like lower low, retracement back in combination with fair value gap zone in order to look for shorts. We don't have anything here. Market just moved to the upside. As you can see, liquidity sweep was here, but market just created higher low, lower high, and we don't have any new lower low at all. We don't have any fair value gap zone as a confirmation. So on the 1 hourly time frame, we don't have nothing here. But let's go now to the 15-minute time frame here at that level at 11th of December. So let's jump to the 15-minute time frame. Now on the 15-minute time frame, let me just zoom out a bit to see your price action here. So here we have, as you can see, we have highs here, we have lows here, and here we have equal highs. Market swept this resistance, this liquidity, buy side liquidity, and then it dropped, created lower high, lower low with bearish fair value gap zone, and so on. So let me just zoom in so we'll be able to see closer the price action. So as you can see, those are the equal highs from Asian session, and in the London and New York session, what do we see here? We have, as you can see, price moving higher. We have this liquidity sweep, so market broke over those previous highs. We had move lower, bounce, we have lower high here, and we have here we have low, and then market, what this it actually decided to create this market structure shift. Previous recent short-term lows were broken to the downside. On the way to the downside, market also created this bearish fair value gap zone here, and it also retraced to the discount. So if you're using the Fibonacci, measuring from this swing high and this swing low, you can see the market retraced 50%. So let me use Fibonacci. From this structure shift, we have this swing high, we have this swing low. Those short-term lows were broken. We have bearish fair value gap zone. So when the market retraces to 50% or more in combination with fair value gap zone here as well, we can focus on shorts. So your entry will be here, stop loss will be around 30 pips, or depends on the price level. You could also place it above the highs, and you will target in this case 1-to-1 the previous lows here. So if you would have like stop loss of 20 pips over those highs, you could target the lows, but because we have the highs over here at 30 pips, then of course you could target the lows of this range around 30 pips as well. So in this case, market just retested the lows and bounced back up higher. So this was the idea here. Now going also back here, you can see if you just focus on the 15-minute time frame, you will see that you will see a lot of opportunities on that pair. So for example, also down there, as you can see at the lows, we have price took this liquidity, sweep this liquidity, the previous lows down there, and we had beautiful structure shift here as well. So if you just focus on the 15-minute time frame, you can see market was bearish, liquidity was swept, which is the first thing, and then you need to see a structure shift. So previous short-term high was broken, market pushed to the upside. On the breakout to the upside, we had also this bullish fair value gap zone. So in this case, when the market changes this shift to the upside, what you're looking for, you want to see a retracement into the discount in order to look for longs targeting those highs. Of course, sometimes price will move in your direction for at least 1-to-1 or 1-to-2 in terms of risk and reward ratio, and sometimes it will, if you will get your entry here, stop loss above here, price will not move in your direction with full profit target, and sometimes you'll be able to just close it at the end of the day. So on the 15-minute time frame here to the upside, the opportunity I mentioned here, we had bullish fair value gap zone, price move to the upside 30 pips. So if you mark your level, the swing low here, the swing high here, as you can see, you will use now the Fibonacci to measure if the market retraced into the discount. So you have most of touches here, so you can just start somewhere here. You will connect the highest or the most touches, and as you can see, the market retraced beautifully after this structure shift was there, retraced exactly to the 50% in combination with some previous lows and highs here, in combination with fair value gap zone. This is great trading opportunity, and as you can see, with entry here at the 50%, stop loss below the lows, below the structure, you will target the highs of this range, or at least 1-to-1 in terms of risk and reward ratio. So this was beautiful opportunity to the downside, opportunity to the downside here. So we have long trade here, long setup, short setup here to the downside, all in one single day. So this was the GBP US dollar. So this was on the 11th of December, for example. Now move on to the 12th of December. On the 12th of December, I had euro and USD trades, which I posted also on the YouTube. But now let's go to this area. So on the 4-hourly, what do we see on the 4-hourly? Here we had liquidity sweep. This is the first thing we want to see. Liquidity sweep, price spiked at all those previous highs here. Liquidity sweep is there. Now second thing, you want to see structure shift on the 1-hourly or 15-minute time frame. So on the 1-hourly, here on the 1-hourly, let me remove those Fibonacci's from before, just to make charts clearer. So we had this liquidity sweep. So this is the first thing. We have this spike, market spiked all over those previous highs. Liquidity sweep was there. And the second thing, you want to see structure shift on the 1-hourly or 15-minute time frame. So on the 1-hourly, we don't have any, as you can see, opportunity. We had just price. Of course, we had this lower low. We had this bearish fair value gap zone. But for this setup to be valid, we would like to see a retracement back. And then we'll look for entry here in order to target those lows. But retracement was not there. It was not big enough to fair value gap zone or discount area. Now we go to the 15-minute time frame. So on the 15-minute time frame, we had beautiful market structure shift, but we didn't get actually a retracement we wanted to see. So focusing on the price action on the 12th of December, we saw price making higher highs, higher lows. We had this liquidity sweep on the higher time frames, from the higher time frames on the 4-hourly. And after that, we had nice, beautiful lower low. Market broke all those short-term lows here. On the breakout to the downside, we had also fair value gap zone here, another fair value gap zone here. And what we were waiting for, using the Fibonacci, we wanted to see a retracement to at least 50% area, because we have 50% area discount here. We had fair value gap zone here. So in this case, what I would like to see is, of course, retracement to fair value gap zone and 50% area. In this case, somewhere here on this market structure shift, entry here in this level, stop loss above the structure, and then you will target at least 1-to-1 in terms of risk and reward ratio, or the hard time frames range down there. So in this case, you could create 1-to-1 or 1-to-2 in terms of risk and reward ratio here. So that's how you can trade the ranges using the daily 4-hourly time frames combination. And make sure you recheck this video again, because using this range trading technique strategy, you can of course also find trading ideas when the market is not trending. And make sure you review it again, check it, and then practice. So thanks for watching, and we catch up soon.